Welcome to the Investing Show, where we discuss the ideas that matter to investors and help you to make more of your money. I'm Simon Lambert of This Is Money. Joining me in the studio, I've got Richard Hunter of Wilson King Investment Management.
Hi, Simon.
Richard. And Nick Batsford of Tip TV.
Simon, Richard.
Coming up in a minute, we're going to be taking a little look at some of the things that have been in the news for investors, but first a quick roundup of what's been going on since the last show. We've had interest rates held, unsurprisingly, but there was one big surprise where 3 members voted for a rise, going against what many people thought. So could we even see interest rates rise this year? Who knows? We'll have to find out. We've also seen inflation come in higher than expected, something directly related to the interest rate scenario. And we have seen house prices slow down ever so slightly. In fact, asking prices are rising at the slowest level in a number of years now. So we'll have to see what happens with the housing market too. But before that, a quick look at some mergers and acquisitions. Now, going back a few years, M&A was something in short supply, wasn't it, Richard? But things have been a bit more boisterous over recent years, and quite a lot more boisterous over the past week.
And indeed could continue to do so. One thing we are aware of course, is the amount of money sat on the sidelines, both in terms of companies and indeed US corporations. Any number of reasons have been given as to why the money remains there. For example, it seems that if, in terms of tax reforms in the US, if Trump pushes that through, it may well be that a lot of US companies repatriate some of that money held overseas. The simple fact of the matter is, notwithstanding any short-term slight interest rate rises, it's still an ultra-low interest rate environment, which means that firms could borrow to acquire. And in particular, of course, if you look at the repatriation of money, putting that to one side, if you look, for example, at the US technology firms, I'm talking about their balance sheets, not the share prices, which we'll get onto a bit later on, but if you look at their balance sheet, they have, you've got people like Apple with money on their balance sheet which exceeds the GDP of half of Europe, for example. So there's always that possibility that not all of that money will get repatriated, but what it will actually go towards is acquisition, because M&A has slowed down. Considering the strength of the economies over the last year, it's actually been relatively low. And of course, we've had the recent news about Amazon Whole Foods, which in terms of the UK read across, for whatever reason, has obviously lifted the Ocado share price as well. So
why has that lifted the Ocado share price? So Amazon is going to buy Whole Foods in the States, which Whole Foods in the States is quite a big chain, whereas in the UK it has a handful of shops. And somehow that has triggered, on the day of recording this show, a near 10% rise in the Ocado share price. What is going on there?
I think one of the main drivers for that is the distribution and the fact that Amazon increasingly, of course, is becoming more of a presence in the UK. But I think what it's also brought into focus is that there are a number of sectors which are absolutely ripe for consolidation at the moment for any number of reasons, and retailers are bang in the middle of that. If, for example, in terms of the food retailers, Aldi and Lidl continue their present rate of growth, then clearly the big supermarkets aren't doing enough to fend them off, so that's going to put question marks on potential consolidation there. Equally, in the clothing retailer space, even the steady stalwarts, the likes of Next, have slightly fallen foul of fashion more recently, and I'm not suggesting they would be a target or necessarily on the acquisition list, but what it does mean is that there will be a lot of larger companies, and who knows, perhaps even some of those companies with the hordes of cash on the sideline looking to run the slide rule over some of the more obvious sectors where consolidation is looking increasingly inevitable.
And one of the things that comes into play here is technology, isn't it? Because Ocado is one of those classic jam tomorrow stories, isn't it? Where basically I think everyone accepted a number of years ago that whilst Ocado was very good and had built up great systems, a great delivery and everything, it wasn't going to knock Tesco and Sainsbury's off their perches. But what they've got is this technology, this distribution technology, and there has always been this could be worth lots of money, but it's always been jam tomorrow. This could be worth lots of money. There's this deal that people have talked about and everything, and the share price has risen and fallen off the back of it. But there's this thought that Amazon might buy it up for its technology. But we saw that last year as well, didn't we, with Sainsbury's and Argos. Argos, good old-fashioned catalogue shop that also happens to be one of the few places that has click and collect absolutely nailed in this country, and ended up with Sainsbury's buying it.
But this goes back to the new industrial revolution, doesn't it? Okay, these PE ratios are factoring huge amounts of good news and earnings for the next 5, 10, indeed 20 years. Ocado has been a trader's delight. It's been so volatile over the last few years. Hedge funds have been involved, lots of speculation around it about the technology. Are Amazon really going to come in for them? The answer is probably at some point yes, but the world's changing, isn't it?
And Richard, one of the big problems with M&A, of course, whenever you see an M&A boom, is the overpaying for things, especially the borrowing money and overpaying for things. In this instance, it's slightly different because, as you were explaining earlier, these people have large cash piles, which they're using to pay for things. But, I mean, as is the problem with any very rich person who everyone knows is sitting on a big pile of cash, putting that big pile of cash to productive use without heavily overpaying for what you're buying can be pretty tricky, can't it?
It can, particularly, and this is the interesting part. You're quite right to bring that up. Because of the way technologies have gained this capital pile, they're moving into businesses which haven't necessarily got anything to do with how they made that cash pile. So if they've got a certain amount of ignorance in terms of experience, in terms of some of the companies they're buying, it may well be that they're slightly overpaying, because M&A, as a rule, by its very nature, is same sector stuff. And one of the reasons, apart from overpaying, that can sometimes not work is cultural difference, for example. Not necessarily between countries, but just in terms of the way the companies have lived thus far. But the difference potentially in terms of the next M&A wave, because it's technology companies, is that they could be going into entirely new lines of business, and that really does open up most markets.
So, I mean, even to go back to the example that we kicked off with, the Amazon and Whole Foods thing. Now, Amazon knows a hell of a lot about retailing. It is, effectively the world's biggest retailer, isn't it? It's a magical business at that. But it doesn't necessarily know that much about bricks and mortar retailing, does it? Which is a same industry, different game.
Yeah, that's right. And, there's going to be this difference between things that can be consumed digitally, such as music, and we've seen the sort of exponential rise in some of those companies, and other things where there is physical delivery of the stock involved and will continue to be so. So that's probably why some, investors in the market have got excited on the Ocado front. That's more around distribution and getting it from A to B, and that's why potentially, the likes of Royal Mail, for example, although they've had a fairly tough time of late for other reasons, have again generally speaking, had a good run on the basis of the boom in internet shopping. There are still packages that need delivering.
However, all is not entirely happy in internet land at the moment, although the share prices of many of these companies have taken something of a battering over the past few weeks, the big American tech companies. However, it should be said that the vast majority of those big American tech companies had risen by a considerable amount before that. So even after taking a battering, the share price is still pretty high. But Nick, you were going to take a look at what's going on there, weren't you?
Yep, so in terms of the press releases that I've sort of run through, Hamish McRae, Evening Standard, June the 12th, high-tech collapse will hit dollar as well as US shares, was the headline. Calling a turning point, as we know, is a bit of a mugs game, trying to pick tops and bottoms, very, very difficult. But on the Friday, the 9th of June, NASDAQ was down 3%. The big stocks, Facebook, Amazon, Apple, Alphabet, Microsoft, down 3%. Dow Jones, new record high, new record close. Okay, so there's some divergence there. Now, since then, the NASDAQ is down 4%. I take your point that it's up about 20%. So far this year, so again, we're not calling the market top, but there was some divergence. Now, this is a really strange time, and it was reminded to me, Tesla passed BMW in market cap recently. Okay, Tesla, how many they're loss-making? How many cars did they make last year?
No idea.
100,000.
That's a really good call. 80,000. Okay. They've got Tesla 3 coming up, which is the great hope. How many cars did BMW make last year?
Millions.
So 2 million. So Tesla got biggest market cap than BMW. So we're talking about the future. Back to the tech. Okay, Goldman's were the reason for this fall initially, and I thought this piece was wonderful. They were comparing the tech bubble with back to the peak in 2000. Their thoughts, driven by the rise of mega tech, momentum as a factor has built a valuation air pocket underneath it, creating cause for pause. I understood the cause for pause bits, but I'm not sure about the rest.
And I'm sure that Goldman had nothing to do with driving that market up in the first place.
What could I possibly say? So in terms of the highlight was if tech does pull back, it will basically hit the US market, so it won't be out on its own. Stock Gen have just basically, Societe Generale have said the dollar is now overvalued. Okay, it's the third biggest US dollar rally after the post-Bretton Woods, and they reckon that basically it's now stalled. It's overvalued, they say, with a clear winner moving from here, the euro. So finally, headline, Wall Street lower, led by tech. Hard not to see the dollar weakness on the back of this, and we know that the hedge funds are massively long NASDAQ stocks.
It's interesting, isn't it? Because realistically, obviously, you know, the American stock market and the American economy is about so much more than those high-profile internet digital companies. But the thing about those high-profile
two-thirds consumer, aren't they?
Yeah, is that they are very, very, very high-profile, and if they do take much more of a, you know, if they do take a proper fall, then it will be big news, and that will affect sentiment, won't it? And sentiment is the thing that counts in markets.
Well, in terms of charts, okay, and charts basically incorporate sentiment. That's the theory. That June the 9th high on the NASDAQ where we had the pullback, we really need to break back above that, okay, for the technicians in the market to say, okay, that was a false breakdown. Okay, that's a really, really key day for technicians.
I think one thing that it's worth pointing out, which we sometimes overlook, is comparisons between now, where this is much more of a technology-driven world, and 1999, where a lot of those valuations at that time, before the dot-com bubble burst, were companies that had never made a profit. In fact, some of them had never even had revenues, and that was entirely the reason for that particular dot-com bubble. So
people dreaming up new ways of valuing companies.
Very much so. Yeah. With calculations that were done on the back of a cigarette packet, and it proves thus. Whereas at least this time, these are fairly established businesses. Some of whom have even made a profit. But when you get examples like the Tesla and BMW thing, that's when you really need to start reading some accounts.
Well, I suppose what's interesting is at what point, you know, not the Tesla example, but with the companies like Facebook and Google, and you know, maybe even the Apples and the Amazons of this world, at what point do they start to become almost utilities, because they power everything that we do, and they start to become a modern day utility? And obviously utility companies tend to be much more modestly priced and defensive stocks, don't they? So maybe if we're sitting here in 15 years' time, we'll be talking about that great defensive stock, Facebook, the utility.
Or we might be looking back to that date, June the 9th, where a big market top was.
Well, we will find out in 15 years' time if you're still watching. That's all we've got time for in this part of the show. Richard, thank you very much.
Pleasure.
Nick, thank you very much.
Gents.
Thank you very much for watching. Goodbye.